How does cash value life insurance compare to my IRA or 401k? So again, not to harp on this, but cash value life insurance is safe, liquid, and tax-free per the IRS code. And if used correctly, it will certainly is an asset on your balance sheet. Now, the differences are, so whenever you take money out of your, sorry about that, or you take money out of your policy, you're borrowing against the policy. So yes, there is interest. That interest goes to the insurance company. And people are like, well, why would I do that? Well, it continues to grow uninterrupted in the policy with the compounding interest. So it just continues to grow. So while you're using it, and of course, if you're playing, as they say in the infinite banking concept, playing honest banker, you're doing what you would do at the bank. You borrowed money from the bank for your car, for example, you make the car payment every month. So you just continue to do those things. So say you bought a car with your money, or maybe you're paying off portions of your car and then you wait until the car is completely paid off. And maybe you're doing it in chunks and it's completely paid off. And now you're funneling that payment back in there. Or maybe along the way you get creative and you refinance it and lower your payment, but you keep paying the same payment. So say it was $500 a month, you refinanced it, and now your payment's $250 because you had paid, a couple of years, 2 or 3 years into it. And it's $250. Now you're putting $250 back into your policy and you're putting $250 towards the payment. And then until you build up another chunk of money, you go and you pay that down. But you paying that payment, you're always paying yourself back. And yes, there is a charge for the interest, but it's no different than refinancing your house, pulling out the equity and going and buying a rental house for cash flow. It's very similar because the houses should ideally, as long as the market doesn't, the housing market doesn't go down, it should ideally continue to appreciate. Well, in this case, it's going to continue, your policy is going to continue to appreciate and say, grow at anywhere from 4 to 5%. So it just depends. Well, one, it depends on the company, but two, it's very similar in that way. And that's an easy way for people to understand that. So with an IRA or a 401k, whenever you pay back a loan, the interest goes to you. But the difference is while the money is borrowed out, it is not gaining anything because it's not in the account. When you loan it out, they just pull it out and you don't make any gains on that. So those are the differences. You will lose growth here, so you better have growth over here, but you can't grow your money 2 times. I mean, yeah, the interest you pay in and they charge you, I'm sure there's a charge on that, but that they keep, but you get some of the interest. So is that really the growth you want as opposed to the growth that it would have been while it was in there? And then the other difference is that with the cash value policy, you have a guaranteed rate and then you have a non-guaranteed rate. And the non-guaranteed rate with most mutual companies, which means they're owned by the policyholders, have been paying for 150 plus years. And they've been paying those dividends and never missed a year. Out of the 13 years I've been doing this, I've never not gotten a dividend with any of my 10 policies. So they're different in that way because that one is more sure that it's going to grow no matter what, even if it's only at the 4% gross crediting rate. And yes, there'll be minus some expenses. So say it's 2.5%, 3%, whatever it is, depending on the company. There again, it depends on the company. It depends on the expenses that they charge. And it depends on how much death benefit there is. And that's going to change also later on this year, third or fourth quarter. when they reprice everything based on Rule 7702 of the IRS tax code, which regulates life insurance. But back to the IRAs, the other thing you're regulated on with the IRA is you can only access money in certain situations, or the 401ks, certain situations. For example, with an IRA, if you have a self-directed IRA, you can take the money out, but you can't participate in it. So say you bought a rental property with that money, you have to have a management company. You cannot manage it yourself. You're violating rules. And by far, I know these things, but I'm no expert. You always want to talk to whoever your custodian is of your IRA, or someone who a tax attorney or something of the sort. So please, anytime I say any of this, I always urge you to talk to your tax professional, whether it be your CPA or a tax attorney or both. Back to what I was saying is that on top of that, you really can't spend the money in any way, shape, or form, or really truly utilize the money with either of those products, for example, which are very popular, until you're 59 and a half. Because if not, first of all, if you take it out, it's potentially taxable. There are a few, very few, maybe one or two exceptions where they might let you access a small portion of the money, if I remember right. But if you do, it's subject to a 10% penalty before 59 and a half. So I'm not close enough to 59 and a half to want to have to wait to spend my money, or to be able to utilize it, or to be able to put it in anything you want. And there's regulations on what you can use it for. Where over here in the cash value policy, you can use it for whatever you want. Nobody's going to tell you what to do with your money. They're two starkly different things. And then the other thing is you're subject to potential volatility depending on what funds you're invested in, and all of that stuff with the retirement fund. Whether it be a 401k or some sort of IRA, you're subject to volatility. And the people don't understand, whenever somebody says you have an average of said return, that's not always the case. I'll give you a good example. So you have $100,000 in your IRA and you get a 50% gain. You get some huge gain because the market just shoots up. And then the market tanks and you lose 50%. You're no longer back at $100,000. You're at $75,000. You're at 50% of $150,000 because you made that initial 50%. 50% of 100,000 obviously is 50,000. You were at 150,000. So you lost 50%. Now you're at 75,000. So you're back to an average rate of return of 0, but you lost money based on how they utilize that. So they don't actually go based off of the compound rate of return, which is actually what should be in that scenario. So it's not 0 anymore. You're at a loss. So whenever they do these averages, those averages aren't necessarily accurate. But there again, in the cash value policy, it's just going to continue to grow. And you're like, oh, well, say 4.5%. I just call it 4.5%. Average is not super exciting. But if you saw the gains, which if you look at one of my other videos, I went through an old policy, and I actually talked about on the last video where I paid $3,400 and I had like $8,200 or $8,300. I can't remember the exact number off the top of my head, but it was a little over $8,000 available to me. That's more than 2 times the money. I mean, $6,800 would be 2. So I've already doubled my money by paying it in and then some. And mind you, this is in year 11 or 12 of that particular policy, because not all my policies are 13 years old. I bought one, I won't say one a year, but I try to buy them or get another one frequently. And I should have been doing one a year, which means I should have had 13, but there are ups and downs in life and whatever. And then I funneled money into some businesses instead of doing policies, which if I was going with the philosophy I should have been, or I should have been cognizant of, that I should have put the money into the policies first into a new policy or whatever, and utilize the money based on loans into the business. I mean, I do that now, but there was a time where I was still trying to grasp the concept, or I was still trying to remember to implement it. And there again, that's why I'm here. I help implement those things. I help you get the idea of, or reminding you that this will benefit you if you do this. So I'm sure I'm probably missing a couple of things with the IRAs and stuff, but like I come back to the thing, I don't have to wait until I'm 59 and a half. I mean, I may look probably old, but I'm a ways away from 59 and a half. I wouldn't want to have to wait that long. I told my brother-in-law that the other day. He's got a very, I won't say it's smart, don't get me wrong, but he has a certain way that he has a qualified plan set up through one of his businesses. And, but he's 53. I mean, he's a lot closer to being able to spend his money than I am. So with that being said, it's a situation where I like control. I like control of my money. And you have control of the money. Despite anything anybody else says, any of the gurus. And some of those gurus are making money off term life insurance, and that's why they want to badmouth anything that's permanent, anything that can build and grow. And there again, why not invest it twice? Why not invest it here where it's going to grow at pretty much a guaranteed rate of return or close to? You know, it's a 4% gross credited rate on just the guarantee. So why not have it grow at 4% minus expenses, which let's say it's 2.5%, 3%. And then even if it's not exciting, and then borrow the money out and use it for something else, whether it's debt pay down and getting out of debt and not paying all of that other interest, which is growth because that money is not going out to interest. So that's growth for you personally. And if not, it goes into a cash flowing asset. Some people flip properties, and some people start out with that side work, and then they end up, being that being their main source of income. But a lot of them were using hard money, and hard money is expensive. So why not be your own hard money lender? And if you're going to utilize it for a business purpose, you can write that interest off. Now, again, check with your tax professionals. But from what I know and what I've experienced, if you use it for a business purpose, you can write off the interest. If you use it for a personal purpose, of course not. Typically, the loan interest on an insurance policy is not tax deductible. But in a business situation, yes. So there's a lot of uses for it. And I get off on these rabbit trails where I start talking about other stuff because the whole thing was just a comparison between the IRAs and the cash value life insurance. I'm partial. I am. I mean, obviously, everything I talk about and whatnot, and the infinite banking concept. And, it's not just infinite banking. People, very similar stuff. Be your own banker, bank on yourself, your family bank, all that stuff is very similar. Might be just slightly different in philosophy, but it's all to your benefit, and it's all used with properly structured high cash value life insurance. Please like, subscribe, hit the notification bell. Any questions, put it in the comments down below. If you would like a consultation, there should be a link in the description for getting on my calendar, or at least taking you to the website, which there's a big button on it that says schedule a strategy session. So catch you on the next one.